Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, let's talk ARMK. Ticker is ARMK. We close the day today, that's Monday, February 9th, 2026, at $38.80 exactly. Now, if you're just, glancing at the tape on your phone, you see a tiny move, plus 0.18%, looks sleepy, it looks flat. You'd think it's a stock just waiting for something to happen. But if you look under the hood, my goodness, the engine is absolutely screaming.
It certainly was loud today. The volume was, an absolute anomaly, and I really don't use that word lightly.
Anomaly is exactly the right word. We saw 9.22 million shares change hands. Now, compare that to the 20-day average, which is usually sitting quietly around, 3.29 million? That is nearly triple the normal activity. The stock is kind of sandwiching itself right between its 50-day moving average of $38.08 and the 200-day at $39.04. It is coiled, it is tense, and with the Q1 earnings call tomorrow morning at 8:30 a.m. Eastern, well, the market is placing some massive bets right now.
The bets are certainly being placed, but the central question we have to answer is whether they are betting on a breakout or, frankly, a breakdown. You look at that volume spike, that triple activity, and you see excitement. I look at it and I see nervousness. ARMK is arguably at the most critical inflection point it has seen in years. I mean, sure, they're boasting record retention rates, 96.3%, and these massive contract wins. But they are also navigating what I would call a minefield of operational complexities in this post-inflationary world. The real question for tomorrow isn't just about revenue. It's about whether this surge represents smart money positioning for a win, or if it's institutions absolutely terrified of another earnings miss like we saw in Q4.
Well, I think the smart money is finally waking up to what I've been calling the sleeping giant thesis. And I want to start my position right there. If you look at the valuation logic, there is just a disconnect you cannot ignore. Right now, ARMK is trading at a trailing price-to-earnings ratio, a PE, of roughly 31.75x. Now, on paper, for a facilities and food services company, that looks expensive. It looks a little rich. But then look at the forward PE. It drops precipitously, all the way down to 17.47x.
Wow. That is a massive compression. It's implying a whole lot of faith.
It is. And it tells us that the market, or at least the rational part of it, is anticipating a huge expansion in earnings per share. This isn't an accident. It's because of the record level of new business. We're talking $1.6 billion in annualized gross new business they secured in fiscal 2025 alone. They're shifting strategically toward these high-margin segments like collegiate hospitality. My view is simple. The startup costs that hurt the previous earnings report, they were just that, startup costs. They are temporary investments for what I see as long-term dominance.
I see why you find that narrative so appealing. I really do. But let me give you a quick reality check on those numbers. You say sleeping giant, I say margin trapped. And the old adage really holds true here. Revenue is vanity, profit is sanity. You just can't gloss over the execution risk. In Q4 of 2025, they missed earnings by 12%. That is an 8-cent miss on EPS. And why? Because of those exact same startup costs you're praising. Onboarding new business is incredibly expensive, and look, they haven't proven they can do it efficiently yet. As for that forward PE of 17x, I am highly skeptical that it's realistic. You have major headwinds. Healthcare costs are rising, specifically the impact of GLP-1 drugs, which hit margins by $15 million recently. You've got regulatory divestitures in the UK. To me, it feels like the company is running faster just to stay in the same place. That high volume today? That could easily be institutions adjusting their rest tables, not some vote of confidence.
I think you're looking at the friction of growth, and you're mistaking it for structural failure. Let's dig into this profitless prosperity paradox that you seem to be worried about. You mentioned the costs of onboarding. I look at the specific wins. Take the 15-year partnership with the University at Albany. That is not a short-term cafeteria contract. That's a 15-year integration into the entire campus lifecycle. Or look at the $10 million investment in Venue Holding. These are anchors. These are long-term, very sticky relationships. When you sign a 15-year deal, of course the first 6 months are expensive. You're hiring, you're renovating, you're training people, but once that machine is built, it just prints money for a decade and a half.
That is a compelling argument in theory, but have you considered the cadence shift that's mentioned in the research? I mean, investors, they need to see bottom line results now, not in year 5 of a 15-year contract. The market has zero patience right now. That unprecedented level of new business, that $1.6 billion figure you quoted, it's a double-edged sword. It strains the supply chain, it strains the labor force. You're talking about a symphony of integration, but if the conductor drops the baton, it's just noise. And the Q4 miss suggests that the integration isn't exactly seamless, right? They're juggling too many balls at once.
I disagree that it's noise. It's actually a very calculated symphony of integration, to borrow that term. ARMK isn't just serving burgers anymore. They are integrating facilities and uniforms and whole supply chains. And this is where the tech comes in. They are using AI to optimize a procurement volume of over $20 billion a year. The analysis suggests they're identifying spend efficiencies that could expand their adjusted operating income significantly. So they're using AI to capture spend data to manage these above-unit costs. That is how you solve the margin compression issue. You automate the supply chain. That's the bridge between that high trailing PE and the attractive forward PE.
AI is a great buzzword, and I know everyone loves to throw it around to justify valuations. But let's look at the peer group to see if this symphony is actually playing a better tune than the competition. You look at the gold standard in this industry, which is, of course, Compass Group.
Compass is the giant, yes.
They are the giant. They have a market cap of over $50 billion compared to ARMK's $10 billion. But here is the kicker. Compass trades at a trailing PE of 21.2x. ARMK is at 31.75x, so just pause and think about that. You can buy the biggest, most efficient player, Compass, for cheaper relative to its current earnings than you can buy ARMK. Compass has better margins, massive scale. So why would a rational investor bet on the smaller, more expensive player that just missed earnings? It feels like betting on the underdog when the favorite is paying out better odds.
I am not convinced by that, because you're looking at a snapshot, not the trend. ARMK is actively winning market share in North America, specifically where Sodexo has been struggling. Sodexo's North American growth has been negative or flat, while ARMK is growing. And if we want to talk about price performance, ARMK has actually outperformed its peers in stock price growth over specific 12-month periods recently. And there's a qualitative aspect here too. ARMK was just named number 4 in Fortune's World's Most Admired Companies for 2026 in their category. That matters. When you're bidding for a big contract against Compass or Sodexo, that brand reputation helps you win. They're scrapping for market share and they're winning it. That, to me, justifies a premium multiple on future earnings.
Winning market share is great, but again, I have to ask, at what cost? And let's talk about who actually owns this company, because this is a structural concern that, well, it keeps me up at night when I think about ARMK. The institutional ownership is at 99.81%.
It is incredibly high.
It is dangerously high. Just think about that liquidity profile. There is almost zero retail liquidity. This stock is a big money hotel. And if one of the big guests decides to check out, the whole building shakes. We saw Farallon Capital sell over 30% of their holdings in late 2025. Now that is a smart, active manager taking chips off the table. If we get a bad earnings call tomorrow and BlackRock or Vanguard decides to trim their positions by even 1%, the stock crashes. There's no retail army to come in and buy that dip.
See, I interpret that ownership structure completely differently. To me, 99.81% institutional ownership means stability. It means the adults are in the room. You have Vanguard, BlackRock, Capital Research and Management holding nearly 30% of the company combined. These aren't day traders. These are long-term capital allocators. But here is the piece of evidence that I think trumps the for all in sale. You have to look at the insider activity. This, for me, is the ultimate tiebreaker. The CEO, John Zillmer, bought 6,387 shares at around $39.07. That's roughly $250,000 of his own money. Executive VP Stephen Bramlage bought $100,000 worth. There's been no significant open market selling by executives. When the people actually running the kitchen are buying the stock, I pay attention. They know what the margins look like a lot better than Farallon does.
Okay, I will grant you that insider buying is a positive signal. It's certainly better than seeing them dump stock. But let's be precise here. Total insider ownership is still less than 1%. It's not like they own half the company. They are paid in stock, sure, but Zillmer's buy, while it's nice, it's not enough to offset the macro risks I see. And speaking of risks, let's look forward for a second. You have a regulatory environment that is getting hostile. The UK Competition and Markets Authority, the CMA, just ordered ARMK to sell Palantir, that offshore catering firm they bought. They ruled it reduced competition. I mean, that creates a ceiling on their international M&A strategy. If they can't buy growth abroad because of regulators and they're struggling to digest growth at home, where does the upside come from?
The upside is sitting right in front of us in the summer of 2026. The FIFA World Cup. This is a massive catalyst that I feel is not fully baked into the price yet. ARMK is operating 27 of the 104 games, including the final. Analysts are projecting this alone will add 50 basis points of growth. That is high margin, high visibility revenue. And regarding your concern about financial flexibility, management is on track to get their debt leverage below 3x by the end of fiscal 2026. That would be the lowest leverage ratio since the company was taken private back in 2007. They already successfully repriced that 2030 Term Loan B. The balance sheet is healing just in time for that World Cup revenue to hit.
The World Cup is a nice event, but it's a one-time event. You can't build a long-term valuation on a soccer tournament. And on the debt, on track to be below 3x is not the same as being there. They are still carrying significant leverage in a high interest rate environment. And please don't forget the healthcare headwind I mentioned. Those GLP-1 drugs, Ozempic, Wegovy, they are driving up employer healthcare costs across the board. For a labor-intensive company like ARMK with hundreds of thousands of employees, that $15 million hit to margins, that's not a one-off. That is a new baseline expense. If they miss that leverage target because healthcare costs eat up all their free cash flow, that forward PE of 17x goes right out the window.
I see that risk, but I would frame it differently. Every major employer is dealing with GLP-1 costs. That's not unique to ARMK. What is unique to ARMK is the leadership stabilization. They just put Barbara Flanagan in charge of collegiate hospitality and Brisbane Violoncourt in student nutrition. These are veterans. They're internally groomed, as the report says. This tells me they are locking down their operations. They aren't scrambling for outsiders. They're promoting the people who know how to fix the plumbing. That leadership stability, combined with the insider buying, it tells me they have a handle on the costs.
Stability is good, but results are better. And right now, the technicals are painting a picture of total indecision. The relative strength index, the RSI, is sitting at 5310. That is dead neutral. It is the very definition of wait and see. The market just doesn't know what to do. It's hovering near the moving averages. It's waiting for a reason to move. My fear is that the reason will be another one of those execution hiccups. And when you are trading at 31 times trailing earnings, you do not have the luxury of hiccups. You need perfection. And frankly, with the UK regulatory blow and rising healthcare costs, I just don't see perfection in the cards for tomorrow morning.
And I see opportunity in that hesitation. The fact that the RSI is neutral just means the stock isn't overbought. It has room to run. That volume spike we saw today, 9.22 million shares, tells me the big players are positioning themselves before the news drops. You don't buy that much volume just to hold it neutral. Someone is expecting a beat. The disconnect between the trailing and the forward PE is exactly where the alpha is. If they confirm tomorrow that the cadence shift is over and the margins are expanding, this stock breaks out of that 38-39 holding pattern instantly. The smart money is looking at the 15-year contracts and the AI efficiency, not the one-quarter miss from last year.
We'll see. To summarize my view, while the volume spike is certainly intriguing, I just can't look past the execution risks. We have a company that is relying heavily on future projections to justify its current price. The reliance on future margin expansion from AI and the World Cup, it feels speculative when you weigh it against the reality of current healthcare costs and regulatory friction. Until ARMK proves they can onboard billions in new business without crushing their own margins, I think the stock is a hold at best, and a risky one at that.
Caution is the only sensible play until we see the numbers tomorrow.
And to summarize my perspective, I believe we are looking at a classic turnaround story that's being misunderstood as a distressed asset. The leadership is stable, the insiders are buying with their own cash, and the new business pipeline is at record levels. The temporary costs are fading, and the structural profitability is about to emerge. That gap between the trailing and forward PE, that's the opportunity for investors who can look past the rearview mirror. I believe the sleeping giant is waking up, and tomorrow morning might just be the first loud roar.
Well, we won't have to wait long to find out. The earnings call is at 8:30 a.m. Eastern tomorrow, February 10th. That's going to be the deciding factor on whether the giant wakes up or just hits the snooze button.
Indeed, it's going to be a fascinating morning for the ticker ARMK. Thanks for listening.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.